everybody. You have seen his writings in the Tycoon Report. You've heard him on Morning GPS, and many of you have had the pleasure of working with him in the Options GPS Elite Mentoring Program. Ladies and gentlemen, it is my great pleasure to introduce you to our newest Tycoon U team member, Ed Pawalik. Ed has been extremely active in the options market for nearly 2 decades. His career began on the Philly Exchange back in 1993 as an equity and equity options clerk, eventually becoming a successful market maker. In addition to working as an options market maker and on the Philly, he also acted as a portfolio manager on the buy side and as an execution specialist in the options market and strategist on the sell side. If you've read any of Ed's articles, you know that Ed is interested in and highly versed in all things financial, and as a result pursued and received the CFA designation in 2008. Now, for those of you that aren't familiar with the CFA, it stands for Chartered Financial Analyst. This is an elite designation. It is held by fewer than 110,000 people worldwide, and I gotta tell you, I am really excited that Ed is now a part of the team. Today, Ed will be sharing some of that options knowledge with you, bringing his expert analysis and the edges that he had discovered and honed while a floor trader. Please join me in welcoming Ed.
Okay, people, thank you very much, Tika. Can everybody hear me okay? All right, excellent, excellent. I'm so excited to be here. Again, my name is Ed Pawalik, and I am the primary instructor for Tycoon U's Options GPS program. Good morning, all. Now, a few weeks ago, Tika and I began discussing using option strategies to leverage the trading ideas that he's imparted during the ETF Master Trader 3.0. He started explaining the methodology, and I got really excited because options are a perfect fit for many of the opportunities that present themselves through the point and figure method of technical analysis. Now, the strategy that we're going to be discussing today is one of the easiest option strategies to implement and will provide you with the ability to further diversify your holdings, better control your risk, dramatically increase your return on investment. Now, there's one thing of great importance, and I know Tika's talked about this a number of times. You have to be comfortable with getting short the market or an ETF or an individual equity. Now, most people realize that other than the directional bias, shorting stocks carries many of the same risks as buying stocks. Well, you can disagree with me on that. After all, a stock could go to infinity, right? So a short stock carries unlimited risk. Well, that may be true, but I know that I have never owned a stock that went to infinity. I might not be sitting here today if I had. Plus, I can assure you that anyone who bought Lehman Brothers at $80 or at any price on its way to bankruptcy felt like they had lost infinitely on the long side. So the point here is that even though investors may understand that in reality the risks are similar, and that if they don't short, they're missing many profitable opportunities, they still struggle with it on a psychological level. So we're going to talk about a means to get short that, in my opinion, has helped many investors overcome the psychological misgivings. All right, let's get right into it then. Today we're going to talk about what's called a stock replacement strategy. What a stock replacement strategy is that in essence, it provides you maximum exposure to price action. It allows you to take profits off the table while still remaining fully invested, right? You can't do that when you are either long or short a stock. You either have to close down the position or take half of it off. With options, you can remain fully invested. The other thing that stock replacement strategy provides is a durable stop. It's not subject to slippage. And I'm going to address that in a moment. Now, again, it increases your return on investment. And the great thing is it works for both the conservative and the aggressive investor. Now, you probably recognize this chart from the ETF class. And I think the best way to explain things is through examples. So for the first example, we're going to look at the contra trade opportunity from April 23rd. Now, this is on the Steel Market Vector Steel Fund, the SLX. So I know in the recent lessons, Teak has talked about this from the beginning all the way up to present day. And I'll tell you what, he did some fantastic analysis on that. We're going to focus in on this area here. So, what are our choices when we get long? Our entry price, if we get long the ETF, would have been $35. That's when the opportunity was triggered. The initial stop was set at 31 for a difference of $4. And I bring this up because I want to touch real quickly here on risk management. And Teak and I are really of the same mind here. You need to be able to define your risk ahead of the trade so that you can apply proper position sizing. A common risk level is 1 to 2% of your portfolio. For this example, we're going to use the 1%. So for a $100,000 portfolio with a 1% risk level, the total shares you could purchase with the stock at 35 would be 250 shares, right? Because our risk is $4. $1,000 divided by 4, 250 shares. Now, if we bought the stock outright with a cash investment, that investment would require capital of $8,750. If you're on margin, your 50% initial margin, $43.75. So, remember that each option contract controls 100 shares of stock. So we can't do 250 with the options. We can round down to 2 contracts or round up to 3 contracts, but we can't do 2.5 contracts. So in this case, we're going to round down to 2 contracts. Now, just so you understand, through this analysis, I did not have the actual option prices for that time. But since I did know how many days there were to each expiration, and I have a pretty good idea of what the implied volatility was at the time, and implied volatility, for those of you who aren't familiar, is a critical input for the options pricing model. I can use the options calculator available to the OGPS members, the options GPS members, and determine a realistic theoretical value for us to work with. Now, the first thing we have to know is how to choose the proper option. First thing, at least 30 days to expiration, but no more than 60 days. For the most part, this is going to fall within the first 2 months of expiration cycles that are available. If you go beyond 60 days, you're going to end up paying way too much premium and not get enough deltas. Now, the options GPS students, they know that as you go further out in the calendar, those in-the-money options, the deltas that are available on those trades diminish. So you don't get as much bang for your buck. In that 30 to 60 days range, that's where you're going to get the most bang for your buck. I'm going to cover delta in a moment, Mark. I'm just going to give you a basic idea, and you will be able to at least grasp it for this part that we're talking about here. All right, the second thing that we want to be able to do is choose the strike that equals your stop. Now, you'll see I have a little asterisk here. ETFs are ideal for this strategy because they offer strikes at every dollar. If you're trading a stock, sometimes you're limited. You may only have $2.50 intervals or $5 intervals. But ETFs offer strikes at every dollar. So you can totally nail it. Now, the reason I put a little asterisk here is because this is somewhat flexible. You may not be able to get the proper exposure at the strike that is your stop. That doesn't mean that your stop is invalid. It just means that you may need to choose a different option to get the appropriate exposure. Now, delta. There's three ways to think of delta. It can be a hedge ratio, probability of finishing in the money, or for this example, what we're going to talk about, delta reflects the change in the option value for each $1 change in stock price. So, if we have an 80 delta option and the stock moves higher by $1, we can reasonably expect that option to appreciate by about 80 cents or 80% of the move. So our delta is going to reflect our exposure to the underlying. Does that make sense, Mark? Not having a glossary, that's okay. Well, this is really the one we're going to focus on, okay, is that exposure to the stock, because that's what we really want to do. When we're involved in a stock replacement strategy, we want to gain as much exposure to the stock as movement as possible. That's what delta tells us. It tells us how much exposure to price movement we have on the option. So we're going to look for one that's, like I said, in that 75 to 85 delta range. 75 to 85% of the stock move will be reflected in the option price. Okay, when you are choosing an option, you need to be aware of the bid-ask spread. All right? Liquid ETFs have very tight markets. If the bid-ask spread is greater than a dime, you're going to want to use a limit order, which you should be using anyway. But if the spread's too wide, this ETF may not be a good candidate for the strategy because liquidity is key. If the underlying lacks liquidity, then the options are likely to lack liquidity as well. So you might need to choose another ETF entirely. Philippe, 1 and 3 are the primary ones. They really need to be met. 2, like I said, that one's going to be flexible, and we're going to see how that comes into play. 1 and 3 are the critical ones. Okay, so what does the trade look like? We're going to choose the June 31 calls, because if you recall, the initial stop on this was 31. It had 57 days to expiration at the time that the alert was given. Again, you're trying to ride a trend here, so you're going to want to choose a little bit of extra time. From that April 23rd date, there were actually 29 days to May expiration, so it was kind of borderline. But when you're trying to ride the trend, you're probably going to want to take a little extra time. So that's why we're going to shoot for that 30 to 60 day window. Okay, based on a stock price 35, the June 31 calls were trading at $4.94, or theoretically worth $4.94, given these parameters. You can see I have a 42% implied volatility here. Now, for those of you who are not familiar with options, implied volatility, you've at least heard this probably on the news programs. Volatility tends to rise when the market's in a panic. In May, we're 2 months off the lows, and there was still considerably elevated volatility before we really got that trend rolling that took us from the 09 lows to where we are today. So to keep this as realistic as possible, we're going to use a 42% volatility. That's going to give us the price that we come up here. Now, I'm not going to get into the details about that, how you price this option. That's really more for the options GPS. But the idea here is what you need to focus on is that 77 deltas and your days to expiration. So this is a comparative chart of long stock, which we see here as the red line. Let me get my pointer out here. This is your long stock, and this is what the option positions look like. So the break evens, right? You want to know where you're going to break even. Well, in the stock position, it's $35. Pretty straightforward. That's where you buy the stock. For the options position, it's $35.94, which is the strike price plus the premium that you paid. Now, you might be saying, well, why would I want to do that? The reason is because options provide a durable stop, and that provides superior risk management. Let's say that the stock, this SLX, right, trades down to 31.10. Not triggering your stop, but darn close. And the next day gaps down on an open to 30.50. Well, you're going to get filled on your stop at the opening price of 30.50 because your stop is going to be triggered. So your actual loss becomes $1,125, 12.5% greater than you expected. Well, that really hampers your risk management because now you're losing more than you anticipated. However, on the option side, say we look 3 weeks into the position, we have that same gap down. The June 31 calls still have value. They're worth $1.38. So your actual loss here is $712, or 28% less than expected. Now, why do I say that this is your actual loss? Because the stop is still the same. It penetrated $31. Your stop is triggered. Just because you're using options doesn't mean that you're going to disregard the stop, but you're going to be able to get better risk management in this situation. So you're going to close that position down when it opens up at 30.50 and sell out those calls for $1.38, losing $712 rather than $1,125. Does this make sense so far? I think, thank you, Mark. Mark just sent me a little message. He said he has an instant poll for me to use, just to kind of get an idea of how much experience that you guys have in this. So this will definitely help. So I'm shooting out a little instant message here, instant poll. All right. So about half of you have used options regularly. Another half are a little, have used a little bit of them, used them a little bit, and some not at all. And a few are options experts, which I love to hear. Love to hear that. Thank you very much. Okay. So we see that what can happen here is the option value can provide us with a durable stop. Even if this was on expiration day, we still would not have lost more than our initial investment of $9.88. Even if the option went out completely worthless, it still provides us a better stop than actually being long the stock. Now, the other reason that you want to choose an option is because it allows you to lock in profits without reducing your exposure to the trend. I can't emphasize that enough. The ability to take money off the table and still remain exposed means that you can extend your profitability. on those good trades, the ones that are working out for you. You can extend your profitability and put money in your pocket, thus further reducing your risk. So, here's a chart of the SLX starting in April and running through July. We see the trade entry date. How did I calculate the $712 loss? Good question. We had an initial investment of $988 because we paid $4.94 for the options. We bought 2 of them. So our initial investment was $988. We were able to sell that option out for $1.38. So actually, it was actually a little less. Good call. I only subtracted 1 option instead of 2 options. But with 2 options, since that was our original position, thank you, our actual loss would have been $712. Yeah, I did figure that out right. For a second there, I was confused. Okay, so let me go back to that and I'll explain that again, now that I've cleared up my confusion. You had 2 options that you paid $988 for. Okay? When that gap occurred, which cost you an additional $125 if you were long the stock, the option was still worth $1.38, so you could close that position out. The net of your investment, less your residual value of the call, resulted in an actual loss of $712. Okay, let me address a couple of questions. Barry asks, how did you get the $31 stop? That was the level that Tika had put in here. The initial stop at $31 below that last column of O's.